What if I told you that the scariest energy crisis the world has seen in 2 decades is quietly making one country richer? Not safer, not more powerful in some vague, abstract way, actually financially richer. Right now, in real time, while the rest of the world scrambles. Because here's the thing, everyone is watching the same news, everyone sees the same headlines. Governments are calling emergency meetings. Energy markets are going haywire. Analysts are talking about a shock to the global economy so severe it could rival anything we've seen since 2008. And almost every single one of those headlines traces back to one narrow strip of water you probably haven't thought about since your last geography class: the Strait of Hormuz. And look, I get it. On the surface, this looks like a straightforward energy crisis story. Supply gets disrupted, prices spike, the global economy takes a hit. We've seen this movie before. But here's what nobody is telling you, and I mean nobody. This isn't just an energy story. It's a positioning story. It's a geopolitical story. And if you know how to read it, it might actually be an opportunity story. So let's slow down, zoom out, and go through this layer by layer. Because by the time we're done, you're going to see this situation completely differently. Let's start with the basics, because you need to understand the geography before you can understand the strategy. The Strait of Hormuz sits at the mouth of the Persian Gulf. It is, without exaggeration, the single most strategically important strip of water on the planet. We're talking about a passage that is, in some places, barely 33 kilometers wide, and every single day, roughly 20% of the world's entire oil supply passes through it. 20%. Just let that number sink in. That means if you shut this strait down for even a few weeks, you aren't just disrupting one country or one region, you are pulling the plug on nearly a fifth of the world's energy supply, simultaneously, overnight. And right now, that plug looks dangerously close to being pulled. So why are markets panicking? Because they should be. Because historically, any instability near Hormuz has triggered immediate ripple effects. Prices jump, inflation follows, economies slow. It is one of the clearest cause and effect relationships in global finance. But here's where the old playbook breaks down. Because most of the analysis you're hearing right now is using a framework that is at least 15 years out of date. Let me take you back about 20 years. 2 decades ago, the United States was genuinely vulnerable to Middle Eastern energy shocks. At that time, roughly 60% of total U.S. petroleum consumption came from imports. So when supply got disrupted, when a war started, when OPEC cut production, when tensions flared near Hormuz, the impact on America was direct, immediate, and painful. Prices spiked. Inflation surged. Consumer confidence dropped. It was almost mechanical in its predictability. The U.S. was a net importer. It was on the wrong side of the trade. But then something happened. Something that has quietly rewritten the entire global energy map and that most people still haven't fully absorbed into how they think about the world. New drilling technologies, specifically horizontal drilling and hydraulic fracturing, unlocked massive shale reserves across the United States. The Permian Basin, the Bakken, the Eagle Ford, fields that were previously considered economically untappable, suddenly became the most productive oil-producing regions on Earth. And U.S. production didn't just recover, it exploded. Right now, today, the United States is the single largest oil producer in the world. Full stop. Not OPEC, not Saudi Arabia, not Russia, the United States, which means the entire framework through which most people are analyzing this crisis, is wrong. Because the U.S. isn't a victim of this energy shock. It's a beneficiary. So if the United States is the world's largest oil producer, who is actually at risk here? Follow the oil. Most of the crude flowing through the Strait of Hormuz isn't heading west. It's heading east. Specifically, it's heading to Asia. And when you break down exactly where it's going, the picture becomes incredibly clear. China, India, Japan, and South Korea. Together, these four economies account for roughly 75% of all the oil that passes through Hormuz every single day. 3/4. So when people say a disruption here would shock the global economy, they are technically correct. But they're also being a little misleading because the shock is not distributed equally. Not even close. For the United States, a Hormuz disruption is primarily a price problem. Because oil is globally priced, when supply tightens anywhere, prices rise everywhere, including in the U.S. That hurts consumers at the pump, it puts pressure on companies, it creates headwinds for the economy. But it is manageable. The U.S. still has its own supply, its own production, its own reserves. But for Asia, it's a completely different situation. Because for these countries, a Hormuz disruption isn't just a price problem, it's a supply problem. And those two things are categorically different. Think about it this way. Higher prices slow you down. They're painful and they create real economic damage. But they don't stop you. You can absorb them, adjust, adapt. But losing physical access to the energy that runs your factories, your power plants, your transportation networks, that doesn't just slow you down. That stops you. And that asymmetry, that difference in exposure, is what makes this so much more interesting than a simple oil crisis story. When supply tightens and prices rise, there are always two sides to that trade. There are buyers and there are sellers. And right now, the United States is firmly on the selling side. But here's the part that most people are completely missing, and it might actually be the most important piece of this entire puzzle. Oil is only half the story. Let me introduce you to the second layer of this situation, because it changes everything. The Middle East isn't just a massive oil exporter. It's also one of the largest exporters of liquefied natural gas in the world. Countries like Qatar and the United Arab Emirates export enormous volumes of LNG to global markets. And just like the oil, the vast majority of it flows through one place, the Strait of Hormuz. Roughly 20% of the world's entire LNG supply passes through this waterway. But now ask yourself the same question we asked about oil. Who benefits when LNG supply from the Middle East gets disrupted? Over the past decade, the United States has quietly, almost without anyone noticing, become the world's largest exporter of liquefied natural gas. The largest. And when Middle Eastern supply gets disrupted, the gap in the market doesn't just sit there empty. It gets filled. And increasingly, it gets filled by American LNG. Now let's talk about the biggest loser in this scenario. Because if the United States is quietly benefiting, someone is absorbing the bulk of the pain. And that someone is China. China is by a significant margin the world's largest importer of oil. They consume somewhere between 15 and 16 million barrels per day, and roughly 11 million of those barrels are imported, with a massive portion flowing directly from the Middle East through the Strait of Hormuz. Now, China isn't naive about this. They have cushion, but cushion is not immunity. Because if this disruption drags on long enough, the math changes. Strategic reserves run dry. Alternative suppliers can't fully compensate for the volume lost. And at some point, what starts as an inconvenience becomes a structural economic problem. And that matters for China for a very specific reason. Because China doesn't just use energy the way a consumer economy does. China's economy is built on manufacturing. Disrupt that flow for long enough, you get factories going quiet. And here's where we get to the most interesting part of this entire story, the timing. Because right at the moment when tensions around the Strait of Hormuz started escalating, something else was happening in parallel. Trade negotiations between the United States and China were reaching a critical inflection point. And now, suddenly we have a crisis that just happens to be creating enormous pressure on China's energy supply, while simultaneously strengthening the United States' position as a global energy exporter. Coincidence? Maybe. But here's a question worth sitting with. When two countries are locked in a complex, high-stakes economic negotiation, what determines who has leverage? Pressure does. Because if one country can absorb an energy shock while another is structurally exposed to it, that shock doesn't just create economic consequences. It creates negotiating leverage. The Strait of Hormuz has always controlled the flow of energy. But right now, it might also be controlling the flow of something much harder to measure: influence. So here's where we land. The world is watching what it thinks is an oil crisis, but the deeper story is about asymmetry: oil, LNG. Both of these markets are tightening at the same time. And in both of them, the United States is the world's largest producer or exporter. And layered underneath all of that is a geopolitical dimension that most people aren't even asking about yet. The timing of this crisis is not something to dismiss. This is not your grandmother's oil crisis. It's something more complicated, more strategic, and frankly more interesting than the headlines are giving it credit for. And the investors who understand what's actually happening here are the ones who are going to be positioned correctly when the dust settles. The question is whether you're going to be one of them. If this kind of analysis is what you're looking for, then make sure you're subscribed.